waking up today. Anyway, so this shows the unemployment rate, and then it peaked in the early part of 2009. You can see that it is trending in the right direction, even though it's certainly higher than we'd like to see it. And on a macro level or on a personal level, anybody we know who's out of work, it's tough, and we have a lot of empathy for that situation. But the trend is in the right direction. So this shows the U.S. stock market represented by the S&P 500 from the low on March 9th of 2009 through March 25th of this year. And you can see the trend is in a definite direction, but you can notice it's not a smooth ride. And it's very difficult to predict when the ups and downs are going to come. This is the 10-year. This is a look at the 10-year, this U.S. stock market over 10 years. And you can certainly see where the Great Recession started and the Wall Street panic and all that happened, and then the climb back out. But you can see that we're back to our new highs and having new highs. This just looks at interest rates for 10-year Treasury notes, and it shows to see how low they still are relative to historical interest rates. And so at some point that will correct itself. We don't know when. We thought it would have already, interest rates would have already moved up. In the last year or two they haven't. We don't know when they will come up. Someday they will, but we give up trying to predict the future, as those of you know who have been in our office and seen the crystal ball on our desk. So I just went on the internet and looked at the current economy, looked at headlines, and on the same page, the first line, this is a copy of it, the perfect storm. And the second item was a bright economic future. So the pundits are all over the map, and you know the media makes a living getting us all excited, not by providing us with consistent, boring truths, but rather by getting us all excited about things being wonderful or being bad. So looking at where are we now and looking ahead, well, the U.S. stock market, again represented by the S&P 500, is currently trading at 15.4 times profits, or what we call the price-earnings ratio, which is a general measure of the market. Since 1962, it's averaged 19.9 times profit. So that tells you just on that one point that the market could have a ways to go. Another kind of indicator is over this previous five-year period, people took $600 billion out of stock mutual funds. But so far this year, $20 billion have added to their stock funds. So the trend has turned. People are getting back in the market. So that brings up this idea of, well, you know, the market hit new highs this week, actually, on more than one day. Finished April with a bang. And so should we really be investing in the stock market when it's really high? Well, we actually got this week some new research, and this is using the daily index for the S&P 500 from 1962 through April 1st of this year. Excuse me, and the blue column over on the left is what looking ahead, 1 month, 3 months, 6 months, and 12 months. The second column says the number of times when the index was higher after a new high. So I think we hit a new high yesterday, maybe. Today it looks like the market was down earlier. It may be up now, but I think yesterday we hit a new high. So roughly 60% of the time, 59.3% of the time, 1 month from yesterday, the market would be higher than it was yesterday. 63.6% of the time, in 3 months from yesterday, it'll be higher than it was yesterday. You can kind of see that number there. And then a year from now, 72.6%. The third column over on the right says the number of cases where the index is higher regardless of whether we had a good day yesterday or not. So regardless of what the market closes at yesterday or today, there's a 60%. But look at the difference between any close and a record high close. What's the difference? Almost none. Look at that, almost no difference. It doesn't matter what the market did yesterday or today. That 60% of the time, it's going to be higher a month from now, and that 73% of the time, it's going to be higher 12 months from now than it is today. That's pretty good odds. I looked at a headline from Bloomberg on March, and saying that leading economic indicators, those are economic statistics that tend to predict the future, were up in March, or up in February for March. The Conference Board's press release, who provides this data on April 18th of this year, and I kind of bolded a couple of statements. After three consecutive gains, the U.S. leading economic indicator dipped slightly in March, with equally balanced strengths and weaknesses among its components. The leading indicator still points to a continuing but slow growth environment. And then in the final paragraph down there, the data for March reflects an economy that has lost some steam, in addition to the headwinds from government spending cuts, i.e. the sequester. The private sector economy may struggle to maintain its momentum, but we have continued slow growth. Same thing we've been experiencing for quite some time now. So what do we do here at Lighthouse? We continue to focus on our research-based strategies that we know work. Asset allocation, broadly diversifying, keeping the expenses on your investments as low as we can, and checking and rebalancing as necessary. By the way, I thought it'd be kind of interesting for you to see in the aggregate of all the money that we manage for our clients and our own personal portfolios for Lighthouse Financial Planning is actually fairly conservative. If you look, about half of the money is invested in stocks, 30% in the U.S. market and 20% internationally, which, by the way, we expect before the too distant future, we'll probably be shifting that a little bit, this ratio of 60-40 U.S. foreign. The U.S. market only represents 45% of the global market right now, and non-U.S. stocks represent 55% of the global opportunities. So we expect to be moving more out of U.S. into foreign in the not-too-distant future. You'll hear plenty about that before it happens. But 50% of the money roughly in the stock market, 6% in cash, and then you can see the rest in bonds there. So this is an aggregate of all of our clients. Some clients are very aggressive, have almost all their money in the stock market. Other clients are much more conservative, but this is the number in aggregate. So what do we do now? We just keep on doing what we've been doing. No crystal ball. We know what we have works. We don't see anything on the horizon that would have us change what we've been doing and what's been working. And those of you that have been with us for a long time know that that's kind of our consistent theme. So I want to thank you. That concludes my part of the presentation here. And in just a second, I'm going to pass it back to Ethan to hand it over to Debbie. I want to thank you very much for coming today. And if you have any questions about the things I covered, feel free to email me or give me a call. And with that, I'm going to turn it back to you, Ethan.